Oil prices are really making headlines again. And, well, we know you want to cut through the noise and truly understand why. So, in this deep dive, we're going to give you a true shortcut to being well informed on this incredibly complex topic. We'll unpack the three surprising drivers behind these movements, not just about supply and demand, trust me. Plus, we'll give you two critical dates you absolutely need to mark on your calendar. And most importantly, we're going to connect all these dots directly to what you pay at the gas pump and what shows up on, say, your business's freight invoices. Look, if you're looking for fast, clear explainers that truly make sense of complex issues, make sure to subscribe right now. It really helps us out. Today's oil price movement wasn't just a single headline, or one big event. It was really a stack of signals, like a puzzle with many pieces. And our mission here in this deep dive is to break that stack down so you can not only understand it today, but also track it yourself throughout the week and beyond. All right, so what are the big questions we're going to tackle today to truly get a handle on this? First, what are the current primary forces really driving oil prices? Second, which specific dates should you be watching next that could trigger big shifts in the market? And third, how does all of this directly filter into what you pay at the gas station and what impacts your business's bottom line? Let's jump straight into it. When we talk about deciphering today's oil movements, the very first place we always look is policy, specifically what's coming out of OPEC++, right? That influential group of oil-producing nations.
Yeah, OPEC Plus certainly have the power to move markets, no doubt.
Wow.
And they do it primarily through their guidance, their announced production cuts or increases. But here's the crucial nuance, and this is really where most headlines miss the mark. Traders don't just take that guidance at face value. Not at all. They immediately try to verify it with actual verifiable exports and inventory data.
Okay, so they're fact-checking, basically.
Exactly. There are two key questions smart traders are always asking. First, are the physical oil exports actually aligning with the announced message from OPEC Plus? And second, are inventories tightening in the critical regions that truly set global prices? Think places like the U.S. Gulf Coast, maybe Singapore, Rotterdam, those key hubs. Because look, if barrels aren't flowing as promised, or if global stockpiles aren't shrinking like they should be based on the announcement, well, that initial guidance simply doesn't hold up in the market.
Right.
And this is precisely where compliance drift comes in. It's a term you hear a lot.
Compliance drift. Okay.
Yeah, that's when OPEC Plus members don't quite stick to their agreed-upon production quotas. Maybe one country overproduces a bit. Perhaps another can't quite meet its target due to technical issues. These subtle shifts, or really any unexpected quota changes that weren't signaled, can completely flip market sentiment within hours, even with the best intentions from the group leaders.
Wow, within hours.
Yeah. That's why watching weekly inventory data, which often shows whether the oil actually made it to storage tanks, is just as important, maybe sometimes more important, than simply reading the latest OPEC Plus statements. The real action and the real price driver is often in the physical flow of oil on the ground or on the water.
Okay, so it's not just what they say, it's what they do, and crucially, what the actual data shows. That makes perfect sense. Now, when most people think about oil prices, they instantly think supply and demand. Simple enough. But there's a quieter force at play, almost like a hidden cost, that I think really sneaks up on businesses and consumers. That's our second driver, logistics risk. You called it the quiet tax on every barrel.
That's absolutely right. It's a great way to put it. Think of it like this. Even if the crude oil price itself remains stable, let's say $80 a barrel, when risks escalate in global choke points or critical shipping corridors, the delivered cost of that oil inevitably rises.
Delivered cost.
Yeah, it's all about how much it costs to get that oil safely and on time to the market, to the refinery.
So where should people be looking? Which lanes?
You need to be watching specific hot lanes on the global map. Obvious ones recently are the Suez Canal and the Red Sea. That's a vital artery for Europe-Asia trade. Also the Strait of Hormuz, obviously, where a massive percentage of the world's oil transits. But really, any shipping lane that starts experiencing reroutes or needs increased naval escorts, these are all immediate signals of rising risk.
And what happens then? What's the mechanism?
Well, what happens then is that war risk insurance premia kick in. These are basically extra charges ship owners have to pay to get insurance when transporting cargo through dangerous areas.
Ah, the quiet tax part.
Exactly. Think of this as a quiet tax on each barrel being transported through those zones. For example, if a major shipping line has to divert all its vessels around the Cape of Good Hope to avoid the Red Sea, well, that journey can add weeks and thousands of miles. When these premiums jump, it can force some cargoes to divert from their usual, most efficient routes. It stretches voyages by days or even weeks.
Which costs more fuel.
Right. This, in turn, increases bunker fuel use. That's the heavy fuel ships run on for those longer trips. So the net effect. Supply feels tighter to the market because those barrels arrive later, and they simply cost more to deliver due to these added logistical burdens. It's a subtle but significant way that price gets tweaked at the margin.
So if I'm understanding this quiet tax correctly, it means a barrel that costs, say, $80 at the source could effectively end up costing $90 or maybe even $100 by the time it reaches the refinery gate, simply due to these hidden logistics risks and the extra time and fuel spent.
That's a very real possibility, yes. The add-ons can be significant.
That's a fascinating insight. It really highlights how these hotlines become almost as important to watch as a big OPEC plus production announcement sometimes. Now, we've talked about where the oil comes from OPEC plus signals versus reality and the cost of getting it to market, that logistics risk. But what happens once it arrives? That brings us to our third crucial factor, refining. So what does this all mean for what happens after the oil is out of the ground and off the ship?
Right, refining. Think of refining as the unsung hero, or sometimes the villain, in your pump price. Refining is where crude oil gets converted into all the products we actually use every day. Gasoline for your car, diesel for trucks, jet fuel for planes, heating oil.
Stuff we actually buy.
Exactly. And what's critically important to understand is that when refining capacity is offline, maybe it's scheduled maintenance, like a major plant turnaround, which happens regularly. Or it could be unforeseen outages, like an unexpected equipment failure, a fire, a storm. Or maybe their margins are simply stressed, meaning it's not very profitable to run crude right now. In any of those cases, product prices, gasoline, diesel, can climb significantly. And this can happen even if the crude oil price itself remains perfectly stable.
That's the disconnect.
It's a disconnect many don't realize. The crude market can be calm, while the refined product market is in a full-blown panic, and that's what hits your wallet fastest.
Okay, and you mentioned cracks, diesel cracks, gasoline cracks. What are those?
Yeah, you'll often hear traders talk about crack spreads, or just cracks. These are essentially the profit margins refiners make on converting a barrel of crude into these specific fuels. Diesel cracks are particularly sensitive to freight and industrial activity. If the margins for producing diesel widen dramatically, that means refiners are charging more relative to crude. You can expect trucking costs and other industrial expenses to follow suit very quickly.
Makes sense.
Gasoline cracks, on the other hand, are highly seasonal. They're tightly tied to driving demand, think summer holidays, and also those specific blend requirements that change with the seasons for environmental reasons, like summer grade versus winter grade gasoline.
So how do we track this ourselves?
So to track this yourself, you need to specifically watch for news about refinery outages, their maintenance schedules, which are often published in advance, and any unplanned events like fires or accidents. These disruptions ripple to the pump fastest, directly impacting what you pay at the gas station or, how much it costs to fill up your company's fleet of vehicles.
That's incredibly insightful. So it's not just the raw material, the crude, but the process itself, the refining, that can really drive prices at the pump. Now, beyond these three big drivers, we've covered OPEC plus signals versus reality, logistics risk, and refining capacity. What about other forces? Things that subtly move prices but might be missed by the big headlines? What are those unseen movers we should be aware of?
Yeah, beyond the direct supply side and processing factors, two major, often overlooked forces are demand surprises and currency movements against the U.S. dollar.
Demand surprises, like people suddenly driving more.
Exactly, or less. Demand surprises can come from unexpected increases or decreases in global travel, like a sudden boom in summer vacations, or maybe a sharp drop if there's an economic downturn, or significant shifts in industrial activity, perhaps due to an economic slowdown or boom in a major economy like China or the U.S.
Yeah.
These can subtly but significantly alter the delicate supply-demand balance.
Okay, and currency, how does that play in?
Currency movements are also critical, especially for a global commodity like oil. Since oil is primarily priced in U.S. dollars globally,
right,
a stronger local currency in your country, say the euro or the pound, can actually cushion import prices for you. It makes that dollar-priced oil cheaper in your local currency. Conversely, a weaker local currency amplifies price increases, making imported oil more expensive, even if the dollar price of crude hasn't changed much.
I see.
And here's a surprising insight, something many miss. Sometimes, a small foreign exchange swing, Remember, FX is just how your local currency stacks up against the dollar, can explain more of the pump price variation you experience than the major OPEC headline you might have seen that week.
Really? More than OPEC?
Sometimes, yes, especially on a week-to-week basis at the pump in a specific country. It's a subtle but powerful force that directly impacts your wallet.
That's a fascinating point. So if even a small FX swing can move the pump price more than a major OPEC headline, what does that tell us about where people should be focusing their attention? It's not always the loudest story, is it?
Definitely not always the loudest story. You need to look at the whole picture.
Okay, now, if we're trying to stay ahead of the curve, give us the calendar. What are the key dates the listener should mark down and watch for next? The ones that could be real trigger points for the market.
Okay, calendar time. You absolutely want to mark 2 near-term trigger points on your calendar. First, keep an eye out for the OPEC Plus Joint Ministerial Monitoring Committee report, which is set for September 4th.
September 4th, okay.
Yes. This is where new guidance could emerge, or any adjustments to production quotas could be discussed. It could potentially reset market expectations. Any changes in output policy, or, importantly, their assessment of member compliance, will be scrutinized heavily here. So it's a big one.
Got it. OPEC Plus meeting, September 4th. What's the second date?
The second date, or rather a recurring event, is the EIA's weekly petroleum status report. That's the Energy Information Administration in the U.S. It's published every Wednesday around 10:30 a.m. Eastern Time.
Every Wednesday.
Every Wednesday. This report provides crucial, up-to-the-minute inventory data for the U.S. Are stockpiles building or drawing down? It also often includes insights into refinery activity, maintenance windows, or even major shipping updates from the previous week. This tells you definitively whether product supply like gasoline and diesel is tightening or loosening in the physical market right now. It's real-time data.
And you guys will flag these?
Absolutely. We'll be here to flag these changes as they drop, so you're always informed.
Perfect. So all these factors are moving the market, from policy signals to refining bottlenecks to currency swings. But how quickly does this actually show up? Like at your local gas pump or on your business's freight invoices? What's the typical lag effect, or is there even one?
Oh, there's definitely a typical lag effect in play, and it's really important to understand it. It's not instant. Crude oil prices usually move first. That's the headline number often. Then product prices, things like wholesale gasoline and diesel that refineries sell, they follow, usually within days or maybe a week or two. And finally, retail prices at the pump adjust. It's not like flicking a light switch. It takes time for that wholesale cost change to filter through the distribution chain and reflect on the big sign at the station.
And does it vary?
Yes, the exact length of these lags can vary significantly. Depends on the region. Local taxes play a big part, and even those specific fuel blends that are mandated in different areas for environmental reasons can affect the timing and the price. But here's a crucial detail, especially for businesses listening. Freight surcharges on invoices often move before the gas station boards do.
Okay. Business impact first.
Often, yes. If you operate a business that relies heavily on shipping or trucking, you might see cost increases reflected in your surcharges, even before the general public notices a big difference at the pump. For example, if diesel cracks expand rapidly, meaning refiners are making more profit on diesel due to tight supply, while at the same time shipping premiums are rising due to those logistics risks we talked about, well, logistics costs for businesses can jump significantly and quickly. And this can happen even without a really dramatic crude oil price spike making the front pages. It's a quiet but impactful shift that businesses often feel first.
That's really critical for our business listeners to understand. So with all these dynamics in play, who stands to benefit in the near term, generally speaking, and who feels the squeeze from these market shifts? Who are the winners and who are the losers?
Well, thinking near term, the winners in this kind of environment are typically the large producers who have stable, low-cost output. Think national oil companies like Saudi Aramco or major integrated companies like an ExxonMobil or Shell. They benefit from higher prices, assuming their production isn't disrupted. Also, refiners who happen to have ample capacity online and running well, they can take advantage of those wider margins, those wider crack spreads we discussed.
Right.
And certain large shipping conglomerates, maybe like a Maersk or an MSC, who have the pricing power to pass on increased fuel and insurance costs to their customers. They can often navigate these changes or even profit from them by optimizing their routes or leveraging their sheer scale.
Okay, so producers, some refiners, some shippers, who gets pressured?
On the other side, those who feel the most pressured are usually the fuel-intensive sectors. Think airlines, trucking companies, manufacturers with high energy inputs in their processes. Their costs go up directly. Also, importers who rely heavily on those vulnerable shipping lanes we mentioned, perhaps bringing goods from Asia to Europe via the Red Sea, if that route becomes risky or expensive. And ultimately, you, the consumer, feel it too. Especially if you live in regions that are experiencing tighter refining supply or have particularly high localized taxes on fuel. These groups directly absorb the higher costs, seeing it in their travel budgets, their heating bills, or their daily operational expenses.
This has been incredibly insightful, truly pulling back the curtain on the complexities of oil prices. Before we wrap up, let's give everyone listening a simple, actionable checklist. What 5 signals can you use to track these complex movements week to week and build your own kind of personal oil price dashboard?
Absolutely. Think of this as your 5-signal dashboard to keep an eye on moving forward. First signal, OPEC plus statements versus actual expert trackers. Are their actions, the barrels actually leaving port, aligning with their words on production cuts or increases? Check the data, not just the headline.
Okay, words versus actions. Got it.
Second signal, freight and insurance premia on key lanes. Are reroutes rising, like those around the Cape of Good Hope? Are insurance costs going up? This indicates increasing logistics costs that will affect delivered prices.
Shipping costs and risks? Check.
Third signal, diesel and gasoline crack spreads. Are refining margins widening? That's a very strong signal for higher product prices coming your way, potentially even if crude itself is stable.
Refining margins, right.
Fourth signal, inventory data and refinery status. Is the overall supply, crude and products, tightening or loosening in the physical market, especially in key regions like the U.S.? And what's the health of the critical refining infrastructure? Are plants running smoothly or are there outages?
Supply levels and refinery health.
Okay. And finally, fifth signal, FX versus USD for your country. How is your local currency performing against the U.S. dollar? Remember, this impacts the price of imported oil that you actually pay at the pump. A weak local currency amplifies the pain, while a strong one can cushion it.
Local currency impact. Perfect. That's a great checklist. So, bottom line, today's oil price movements weren't simple. They came from a powerful combination of policy signals, escalating logistics risk, and the complex math of refining, plus those quieter pushes from global demand shifts and foreign exchange rates. If you set alerts for those 2 critical dates we discussed, that OPEC Plus meeting on September 4th and the weekly EIA report, you'll be ahead of most headlines when it comes to understanding what's truly moving the needle in oil prices, and crucially, how it impacts your daily life and your business. If this deep dive helped you cut through the noise, make sure to subscribe right now. Next, you can watch TikTok decision banner sale, timeline and what changes first, or jump to our South China Sea breakdown for the security picture. Thanks for being here, and don't forget to subscribe.